Hello, today is Tuesday, April 3rd, 2008. This is Brian Shannon from alphatrends.net. The market's closed here. S&P 500 finished with a gain of 10 cents today, and let's just review the recent activity here. As we know, we've broken this downtrend line after the market found support in the same area that it had, the January lows, and then this is where the Bear Stearns news came out. Now, there's a lot of people calling this a double bottom. A true double bottom, the way that a double bottom forms is, you find support in the same area, and then what you'll see is you'll see a breaking of a trend line. A breaking of a trend line doesn't mean that the trend has reversed. It means that the rate of descent has slowed. Now, on the positive side, what we see here is we've got an advancing 50-day moving average. We've also got the average price for this S&P 500 this year is right now at about 135 or so. So back to our double bottom scenario, what we want to look at is when a double bottom is completed, and when you can call it a double bottom rather than just support in this area, is when the when the resistance is broken right up here. So what we do is we label this point A. This would be point B up here, and point C would be the test area. When it breaks past that level, what we do is we take the height of this pattern, which is 126 up to 149, so that's 139 rather, and we add that to the breakout point, so 13 points added to 139 will give us a price objective at about 152 or so if the market can get above 139. The only way that you can really truly call this a double bottom is to have the market rally back up above 139. So enough double bottom lessons, because we've got still obviously this 139 and a half to 140 level that is looming as the larger level of resistance. It's encouraging to see that 2 days ago we saw the rally in a nice increase in volume, and the last 2 days it's been consolidating those big gains and holding on to those gains. It's done so on diminished volume. That shows there's not a rush to the exits here, and we're holding above these prior levels of resistance near 135. And again, that's about the average price that the S&P 500 is traded at this year. So when we look at the intraday time frame, what we see is this level is holding as support for now, so that's a positive to look at. We do have a pattern of higher low in here, and after this higher high. The only thing I would say is that it looks like it's just consolidating within this range right now. On this 30-minute time frame, we do have a lower high. I wouldn't read too much into that yet, because I think it's just more consolidation for now. On the 10-minute time frame, yesterday we saw these lower highs and then the market break down a little bit. Today, I had drawn this in on the midday update level as far as a very minor level of resistance. The market broke nicely above that, broke back down, and then held above it here today. So the 136.50 or so seems to be an intraday short-term level of support. More importantly, though, is this level here at about 135.80 or so. If the market breaks below that, then I think we're going to see probably a test of 135 and just a little bit below there. Overall, though, the market continues to act very strong here, and you've got to be impressed with the resilience of it and the lack of new sellers coming into this market. So markets big rally, big movement corrects one of two ways. It either corrects by pulling back in price, or it consolidates through time. And a time correction is actually more bullish, because it shows us that the sellers aren't rushing to the exit. There's an underlying bid to this market, and just simply a lack of supply for this moment. But if the market does break back down, then you've got to take action. If it breaks below this level here, then you've got to look at that as a serious short-term technical violation, and a good reason to be defensive. Again, you always want to have all your options available to you and be aware of all potential scenarios out in the market. So the XLF, this one also, again, it continues to be held captive by this downtrend line, and it's really battling with this 50-day moving average, which is starting to flatten out. So we're seeing signs of accumulation in here. Bullishly, again, it continues to hold above that 2620 level. 26 to 2620 really is what we want to call it. This is a key level for this market. These couple lines that I'm drawing in here. We can see that the market tested that, and now in order for some short-term strength to materialize, and perhaps this inverted head and shoulders pattern to take hold, we would need a movement above this level right here at about 2720 or so. It doesn't mean that you want to just, if it breaks above there, that doesn't mean we're going to meet this bullish objective based on the height of the head here, which again yesterday I'd measured out and leads up to a very conservative target of 31. But obviously, with the market in this big of a downtrend, you want to be cautious with those upward, bullish upward objectives, and listen to the message of the market. Higher highs and higher lows is an uptrend. So if this market can take out this level, then perhaps we're going to see a leg higher, and maybe it takes us up towards 31. But manage your risks on the shorter term time frames. The let's see, the IWM Russell 2000. These finished with a gain of 20 cents. Very encouraging to see that this prior level of resistance near that 70.5 area is holding a support. We've got a little bit of resistance up here at about 71.5. Breaking above 71.5 then I think puts into play once again this 73 level. I don't think that's going to be an easy level for this market to take out. If it did take that level out, though, you could make a similar case for a double bottom. Height of this pattern would be at about 9 points, and that would give us a price objective up near 9 points, $82 a share. So again, it's tough to see that as a case. I think this $73 level will be more heavily contested. We're starting to see earnings. Research in Motion, provided some nice visibility for some tech stocks, but we've got a lot of work to do still to really become fully bullish on this market. You can trade the bullish side on the long here, but and there's some great setups. I pointed out midday today. The semiconductors are breaking past some key levels in here. These levels haven't been seen since the first and second days of this year for the semiconductors. So semiconductors typically lead the NASDAQ, and they've got some room maybe up towards that 32, 33 level. So, if you're looking at the semiconductor index, this was a pretty key breakout, I think, past all this level of resistance here, and that bodes well for the rest of the market. What you want to see is that this $30.20 level now acts as support for the semiconductors. Similar bullish action is also found in the XHB. I'd mentioned these yesterday morning, and listed half dozen stocks or so that are looking set up. XHB being the home builders. There's a lot of big short positions in these stocks that are looking like they're about to turn, that are about to turn negative. That is, they'll be in a losing position. That could add some real nice upside here. It's bullish to see the market finding support right there at that 200-day moving average. So we've got a lot of good things happening in this market. The NASDAQ 100, again, that 46 level is the key barrier holding this market back right now. It's good to see a digestion of the gains right underneath that level. It builds energy for hopefully a breakout and a squeeze maybe up towards even as high as that 200-day moving average, and put us into testing these lows from back in November of last year. So we're seeing bullish action take place. These key levels are holding as prior resistance. It holds as support as this market stair steps higher. Again, this market was most impressive for holding above that 43 level. Now we've got a nice pattern of higher highs and higher lows. If this market takes out 46, I think we could see a nice another short squeeze higher, and possibly put that 200-day moving average within reach.